Hello and welcome. You're watching Market Movers, and we are focusing on certain stocks today. The ones on our radar that we put the spotlight on are BHEL and ONGC, of course. Take it on the chin as the Q3 earnings disappoint. Axis Bank attempts a recovery, while SBI sees some more cuts as NPA woes weigh on the counter. There's Wockhardt and Focus as well as National Aluminium, Page Industries. All of these counters crack on the back of weak earnings. There's Union Bank that continues to remain under pressure after it reported a weak set of numbers yesterday. The counter reacting more adversely in today's session. And of course, the big refiners, IOC subdued ahead of earnings today. It's another weak day for Just Dial. As it slips further, Team Lease makes its debut on Dalal Street as well. Let's do a quick market check and see where the Nifty is. And I mean, true to expectation, we were seeing the SGX Nifty, which was bumped up by around 100 to 110 odd points. That seemed a little stretch only for starters. Post that, you saw a mild gap up opening of around 40 to 50 odd points. We attained a high of 7026, and look at the fall we've seen from there. We've recovered a bit now, but we attained 6919 as far as the low of the session is concerned, and we significantly breached beneath that 6950 mark. Now we are at 6970, some bit of a recovery and almost trading at parity now as far as the benchmarks go. All right, Jubilant Foods, moving on to that counter, and it has posted their set of third quarter numbers. The total income has come in at 633 crores, while profits were 31 crores, and it has been a little subdued on the operating as well as the bottom line. To discuss the quarter gone by, joining me now is Ajay Kaul, CEO at Jubilant Food Works. Thank you for joining us on the show, sir. Let's start off with, first of all, how the quarter has been. It has been a little subdued on the profitability front. So if you could start off with that and the highlights of the quarter.
I think the quarter for us as a company went off reasonably well. I could look at it from 3-4 angles. Given the state of the market, which is, QSR or food service market in general, or extending it a bit outside of that into the FMCG space, has been, not too good. You have the results in front of you of some of the formidable players, so you know the whole story. Given all that, I think opening 40 new restaurants, growing at a system level at around 14%, at a same-store basis at around 2%, I think, given all this, we believe is a good performance. However, given what Jubilant Food Works has been delivering over the last so many years, it doesn't satisfy us because we believe that we can probably do that much more. And given the kind of investments we have been making for, building a company for medium to long term, for investment in our factories, investment in building new stores, into what we invest on technology, people, and so on, we want these numbers to be far higher than, what we had delivered. As far as profitability is concerned, I think despite, these tough conditions, the commodity price falls, and as a result, what happens on our food inflation index and so on, I think we have done pretty well, but it has got compensated a bit by personal expenses and a bit with rental. Talking about personal expenses in particular, there is a one-off adjustment item in this quarter, and if you were to back that out, this is basically led by the Bonus Act, where 110 basis points impact has come from retrospectively led, impacts because of the Bonus Act. If you were to back that out, I think our profitability numbers are fairly good. We have been able to, kind of maintain it if you were comparing us to exactly a quarter back. So I would not be worried about, costs going forward and how we manage them. But this quarter has still yielded reasonably good results, even from an EBITDA and PAT perspective.
Fair enough, sir. Let's move on to the same-store sales growth then. I mean, you are in a phase where you're expanding Dunkin', of course. That's a newer entry. Given the fact that you are expecting a slower momentum in sales from the same stores, plus the fact that the continued pace of restaurant expansions will go on, do you see the same-store sales growth from Domino's as well as the existing ones from Dunkin' being a little subdued going ahead for a few quarters?
See, we do not want to make any future guidance numbers for same-store growth. We did say a couple of quarters back that we do believe that in 4-5 quarters we should be able to deliver a high single-digit same-store growth number. But because the market has continued to be protractedly, not delivered the change in consumer sentiment, we do not want to make any guidance or any kind of statement on same-store growth, while looking forward. However, as far as, opening of new stores is concerned, we do believe this year for Domino's Pizza, we should be able to deliver around 150 new stores. and for Dunkin' Donuts around 20 to 22 new stores for the full financial year. And as far as going forward is concerned, numbers, which are kind of in the same ballpark for both, should be something which we can deliver. As far as, full potential of Domino's, something which gets discussed often is concerned, we believe there is potential to open 700-800 Domino's stores in India still over the next so many years. And we are building all our infrastructure to kind of support that, whether it's in terms of new commissaries. We have today 9 such factories. We had commissioned 3 last year. And this year, as we speak, we are building one mammoth facility in Greater Noida. Similarly, as I was talking about investment on technology, 36-37% of our total revenue, today out of the delivery sales actually comes through the online medium, which is through the internet. And 38% of that comes through the mobile. So mobile first as a strategy, investment in that, creating the right kind of platforms is all that investments which we are making for building a company for future.
So in terms of expansion, as you said, you're looking at another 150 outlets for Domino's and 20 to 22 for Dunkin'. Given that, of course, your expenses, employee costs, rental, marketing and advertising is also likely to go up. So do you see the overall margins remaining subdued for a bit unless and until this expansion comes completely on stream? As also, as you were saying, the move towards greater online delivery booking as far as that is concerned, the greater shift, 36% as opposed to 27% is what I understand. So that is also seeing traction. A brief word on both these aspects.
See, from the external environment, there are going to be some inflationary pressures, especially on the personal cost. Like the Bonus Act came like a bolt from the blue, and it had significant impact. Around 110 basis points is the impact because of retrospective effect, and 30 basis points will be quarter on quarter. So these are like things which come, out of the equation, and then they kind of make you kind of go back to the drawing board. But there are also positive impacts which come from lines like, the commodity costs, or call it the food inflation, which is definitely under control, and we are managing it quite well. Now, going forward, I don't want to make any statement on whether our margins will improve or they will go down and so on. All I can say is, and as we are in the midst of our budgeting process, we will firm up some numbers soon. All I would say is that deployment of some intense Six Sigma, initiatives within the company, with strong focus on efficiency and productivity rather than cost cutting, we do believe we will be able to manage our cost lines also very well, and hopefully with a bit of, fillip from an improving consumer sentiment, which we are in the heart of hearts very positive about, although we don't want to kind of stick our neck out and say that right now. I think, situation will improve going forward. See, the key point here is, and I want to kind of reiterate it again, our belief in the consumption story, our belief in the middle of the pyramid, our belief in the hinterland story of India, the tier 2, tier 3 cities, we are today present in nearly 230, 240 cities in India, is still firmly intact. It's only a question of a few quarters here or there that the numbers are not stacking up, but as soon as that were to happen, we want to be ready more than anybody, any other player in the market, and we want to hit the road running as and when that upswing, or call it the turnaround, starts happening.
All right, we leave it at that, Mr. Kaur. Thank you so much for joining us and shedding details about Domino's as well as Dunkin', and a detailed explanation of the earnings numbers as well. All right, moving on, as far as the markets are concerned, we are right now beneath that 7,900 level. We discussed stocks as well in today's session with our market experts, Avinash Gorasakkar of Precision Investment Services and Mohit Gaba of mohitgaba.com. Welcome, gentlemen, on the show. What is your view? I mean, we have seen some bit of shorting coming in again after the mild gap up that we saw and the exaggerated bump up that we were seeing in pre-opening by the SGX. That got muted a little. What is your view in the near term?
My sense is I think the markets would remain a little volatile considering the kind of corporate results we have got from the PSU banking pack. More importantly, if you look at the kind of liquidity flows, I think we still are likely to see further liquidity outflows. And I think overall, if you see, I think the budget is going to be an important document for the markets, which would give some sort of directional call for the market. Clearly, I would presume that probably in the next 2 to 3 weeks, markets are expecting that some relief for infrastructure or maybe capital goods. These are sectors which are going to require a lot of push from the government. So probably some sort of push from the government, and more importantly, when earnings recovery happens, at least the earnings recovery, my sense is even FY17 is not going to throw a big bag of surprises. We could be looking at not more than 10-12% earnings growth. So it's going to be a challenging first half, and probably second half, hopefully macros improve, then you will probably see some sort of buying coming in. But till that time, it's going to be very volatile and extremely choppy.
Mohit, technically, what do you see? What are the next levels that you see on the charts? I mean, we were in discussion with Jay Bala yesterday. He was pointing out a level of 69.20, and should we reach that level soon, there might be certain further downside. But what levels are you seeing on the downside, at least as of now, and the near-term resistance for now?
See, we've seen the Nifty drop 500 points in the last 5 days.
Yeah.
And today we're trying to see some kind of holdout. Last day of the week, maybe some covering has happened because a lot of traders would have gone short in the beginning of the week and don't want to take positions overnight. Having said that, the trend is still down. We're still looking weak on the charts. After such a big down move, it's bound to see some kind of sideways consolidation or upward reaction, which could happen today. And odds are we'll continue moving lower in the next week or two. The next levels to watch out for would be, of course, 6800 is the level I'm looking out for, but 69.20 is also a possible support area. However, the trend is still down, so instead of looking at support, you try and play the downside and keep trading stop losses at 50, 60, 70 points higher.
Right. Do you expect some short covering bounce coming in today's session in the second half?
It certainly is possible because, as I said, like traders are sitting on 500 points of profit, 400 points of profit, which they would have initiated trades in the beginning of the week. And a lot of them would not want to take these positions for the next week, not want to hold them over the weekend. So you could see some kind of short covering happening today or before the end of day. However, the trend is still negative.
Right. We are also focusing on BHEL today. Pull up that counter for you. Extreme weakness after the set of miserable numbers. There's been a provision as well, which has been of an exaggerated quantum. The stock is down almost 9%, has really partially recovered from the day's low. There are certain brokerage views coming in as well with price target cuts. Shell now joins us as to what the brokerages are making of the stock. Shell, not a very optimistic view as far as the brokerages are concerned, isn't it?
That's right. So when you're looking at most of the views coming in from the brokers, it is clearly on the negative side. And this time around, even when you're looking at the numbers, it's been a pretty big loss, around 1100 crore rupee loss versus a 200 odd crore as compared on a year-on-year basis. But let's start off by taking a look at what brokerages are saying. Let's start off with Macquarie. They go ahead and say this is another one of their disastrous set of numbers, and the numbers are much below their own and also the street estimates. The company went ahead and took a large provision of 1200 crore on doubtful debts in the third quarter. Macquarie has gone ahead and cut their EPS of between FY16 to FY18 by 36 to 110% on lower revenue assumptions, and also they've gone ahead and maintained their underperform rating on the stock with a price target of 89. Previously they had a price target of 114 on the stock. Credit Suisse has also gone ahead and cut their FY16 to 18 EPS by 46 to 125, 46% to 125%. They say that restart of the stuck and slow projects could take time due to lower sector PLFs. Their price target is at 100 rupees, which implies a 0.7 times price to book, and they maintain their underperform rating. JP Morgan says that the December quarter was the weakest in the history of the company. They say that the management commentary does not suggest reduction in gross margin recoupment anytime sooner, and they say that the employee cost decline was much lower than what was expected for the third quarter. They say that they think that it's still not too late to sell, reiterate the stock, and they have an underweight rating on the stock as well.
All right, Shahil, thank you for that. Quite a mellow commentary coming in as far as even the fine print from brokerages is concerned, and Macquarie as well, importantly cutting the EPS targets for the company. Let's start off with pulling up the RSI, I suppose, for BHEL. It's already, I mean, the one-year low is 105. We are at 108 right now, and the stock has seen a significant undershooting. I mean, in the last week, it has only lost and lost. RSI at 18.7. Mohit, starting with you. Extremely oversold. Do you see some bounce from here or a further downside?
Well, the charts look extremely weak. I remember speaking about this in the beginning of the day yesterday, and it was trading around, I think, 125 levels at the time. At that time, the view was also that it was negative, and it still continues to be negative. This may not be the best point to kind of go short on the stock afresh because it's already nearly 10% down. But nonetheless, the targets in the chart are 100 because that was the previous low, the lowest point in the last year and a half. So it could touch 100 again. If it breaks through 100, then then it opens up a fresh range on the downside. So still a sell. The trend looks weak. Certainly not a buy.
All right, even at these levels, you say it is still a sell call. Avinash, let's talk about the fundamentals as well. I mean, yesterday there was a 3,500 crore order flow, but I really doubt in terms of the order execution, the kind of backlog that BHEL is sitting on right now, and even segmentally, there was a loss expansion as far as the power segment is concerned. What is your view? I mean, is there any uptick at all seen fundamentally as far as the order execution or the booking of orders is concerned? Because obviously they have a relative advantage being a PSU in terms of government orders.
No, I think, I think order execution is going to be a very crucial kind of input, because they are already sitting on a good order book. Yesterday, some 3,500 crore order book came in. But I think what the market is probably looking at is that even as of now, Chinese imports have posed a severe problem. And more importantly, on ground, I think incremental order flows have been pretty weak. So, I mean, my sense is that at least for the next 2-3 quarters, some sort of big re-rating on the stock looks very much unlikely. And I think on both the EBITDA margins as well as on the bottom line, I would not be surprised that, for the next couple of quarters, one should not expect any big positive surprises. In fact, clearly the employee cost still remains quite elevated. That is a kind of a pain, in these kind of times when your fixed costs are higher. So clearly, I think I would not be surprised that probably the stock may not, probably the beating has happened. Maybe the stock could possibly come down to 100 odd levels and settle down there. But incrementally on the upside, I don't think any big re-rating would happen. So probably, investors who have the stock can only hold it. But if you're having a 12 or 18 month horizon, that is probably a time when BHEL can actually give some, positive returns. Otherwise, in the next 6 months, it's really unlikely to expect BHEL to actually outperform.
All right, so remain mellow on that counter. Let's pull up Tata Motors for you. I understand the counter has all of a sudden shown some bit of a spike. The price action is also quite robust. It's 4.9% higher for today. And, I mean, given this that it's up 5%, you also have to see it in context of the week. It's 11.49. It's down 19% for the last 4 sessions, and 5% of an up move is only a partial recovery that you can call on Tata Motors. Pull up a Tata Motors DVR as well at this point. Let's see what that counter is doing. And you saw the numbers also, which were pretty much in line. The standalone losses have contracted. DVR is also up a little by a greater margin than the Tata Motors stock, 5.2% up for DVR and also for Tata Motors. So that stock is seeing some bit of a traction in today's session at this point. 289 is where Tata Motors is. Anyhow, moving on, pull up an ONGC as well. It's down almost 4.5% in trade today. The numbers obviously were beneath estimates as far as the profit numbers concerned. There was an impairment as far as their KGD6 assets go on a quarterly and a 9-month basis. Rest of the numbers have been in line. So, I mean, there's no reason for this exaggerated down cut. The net realizations at 44 and the revenue number also being pretty much in line with estimates as far as ONGC is concerned. But the real pain will come in the next quarter going ahead. Avinash, let's start off with you. Do you see any near-term triggers? I mean, 1 or 2 relieving factors have been that there's no subsidy outgo in this quarter and possibly not even in the next quarter because kerosene is below 12 per litre. But having said that, given the kind of rout that crude has seen and the gas price revision that is upcoming for April, which is likely to be even lower from $4.2 per MMBTU, any triggers at all that you see fundamentally for ONGC?
No, I think at least the next couple of quarters, I think with crude prices remaining soft plus a lower kind of gas price, and more importantly, I think clearly, the kind of overhang we earlier saw, on the FPO side, probably markets are also expecting some big FPO to come from ONGC. My sense is I think this stock will continue to underperform as long as crude continues to be soft. And clearly from an earnings perspective, I would say that it doesn't warrant for anybody to actually rush and buy the stock at the current level. Maybe giving it a time of at least say 3 to 4 months, probably as developments go, if crude obviously settles down at $45-50 a barrel and then probably stabilizes, then probably one could take a call, because one positive part about yesterday's numbers were that the subsidy element was completely nil, which earlier used to drag the earnings. But overall I would say that it's going to be a market performer. I think clearly depending on how crude behaves, ONGC stock would obviously go up and down, but the overhang on the stock could possibly come in once the government announces an FPO, which I think probably in the next year something on this line could be lined up.
And ironically, when crude was at 70, they had a net realization of 35 because the subsidy out was $40 per barrel. Now when crude is at 40, they have net realization of 44, which is higher at a nil subsidy outgo. So that's quite a predicament as far as ONGC is concerned. Interestingly, also a fun stat here. Today is the date which exactly ONGC attained a high of in the last year, the 12th of February, 351. And in today's session only it has attained a 52-week low, which is 191. That's a big fall, and given the kind of crude fall and now becoming a direct proxy thanks to the subsidy overhang going out, what is your view, Mohit, on ONGC technically?
Technically, ONGC gave a fresh breakdown yesterday. when it closed below the levels of 207. Now it still looks weak on the charts, and one could still go short on ONGC's stop loss of around 198 levels and have targets of 175 to 170 in the next few weeks, if you're playing a positional downward move on it. So ONGC still looks weak and certainly can move lower in the next week.
All right. By an extension, just briefly, a word on Kane as well, being an explorer.
Sure.
And obviously, since it is a predominantly onshore explorer, so their OPEX is much lower than a deep water player. Any view there?
Kane on the charts is looking slightly better. It's trying to form a base formation between 107 and 125. However, having said that, the trend is still weak and it's by no means a buy as yet.
Right.
If it breaks 107, 105 levels, it can certainly move lower, and then it gets fresh ground on the downside.
Right.
So what ONGC's made a breakdown yesterday, Kane might make a breakdown if it breaks below 105, 106 levels.
All right, so that's an important level to watch out for as far as Kane India is concerned. And of course, there are other levers as well to this as far as Vedanta and the merger and the issue ongoing there is concerned. Let's take our focus now to Axis Bank. That's one of the solitary heroes in this market rout, in today's session at least, up 1.8%. But given the context of the fall, that count has also seen in this week. It's only gained 2% on Monday, and post that it has seen a fall. It's at 383 right now. The MSCI inclusion also coming in. That's a positive. That's holding it out against the rub of the green, pretty much against the major banking counters. Avinash, what's your view on Axis Bank?
No, I think from a longer term stance, I think Axis Bank definitely, should do better because it's one of the frontline private sector banks. And in terms of asset quality stress, I think a lot of positive commentary came out after the Q3 numbers. More importantly, the short term trigger could be the MSCI inclusion from February 29th. But I think clearly, if you look at Axis Bank relative to the PSU banks, I think, at these levels, up to a certain extent, you can't discount the book. And obviously, some amount of deterioration has happened on the asset book. But going forward, hopefully, if disbursements are probably done better, I think they definitely are better positioned compared to most of the PSU banks which have given horrible results. So I would say that, if somebody has a 12 to 18 month horizon, this is a good entry level price, provided, the time horizon is slightly longer.
I mean, even in yesterday's session, take a look at these private banks. They also saw quite a big beating yesterday. I mean, we keep talking about your SBIs and your BOBs of the world, but you take a look at Kotak, IndusInd, all of them saw major cuts. And I mean, on this chart, we have a 5-day return, which is this week. The biggest laggard, of course, are PSBs, but ICICI is down 7 to 8%. So private sector banks also are feeling some bit of a pinch. But talking about Axis Bank, what is your view? What is the level that you're tracking there? Do you see some increased momentum from here on?
See, Axis Bank, between Axis and ICICI, which have seen big down moves in the last few quarters, Axis is trying to hold out. It's trying to form a base between 370 and 410, 415 levels. Now,